It's Thursday, November 4th, 2021, and today we're talking about momentum fundraising. Tiger invests $37 million in float. No momentum yet? Be a repeat founder. Practice raises $10 million US. Scaling hardware is hard. Ecobee sells to Generac for $770 million. And in our lightning takes round, Uvaro raises and AlayaCare goes shopping. Let's get started. First, momentum fundraising. Tiger invests $37 million in float. Alex, who else is participating in this round?
Well, just one thing. Why aren't we broadcasting live to TikTok? I'm pretty sure we can do that.
We can broadcast live to TikTok. Where else do you want to broadcast live to? Roblox? Where else do your kids spend all their attention?
Roblox? Yeah, sure. TikTok and Roblox. Then we'll get all the 20-year-olds, up and coming founders. But anyways, let's get back to Float and the news. So Float raised 30 million USD from Tiger Global with participation from Golden Ventures, Sousa Ventures, Michael Hyatt, Tiny Capital, Garage Capital, A-Star, Global Founders Capital, and a bunch of notable angels, including Jamie McDonald, Andrew McDonald, all the basically McDonald's and angels in Canada, Mike Catchin, Kirk Simpson, and many others.
Who is Float?
Well, instead of me answering this, why don't we get Float's CEO to come up? Rob Kazem's joining us right now.
Hey guys, Thanks for having me.
Thanks. So Rob, why don't you describe what Float does?
Sure. So Float offers Canada's best SMB charge card and corporate card, and we do that through software. So basically, we make it easy for any company in Canada to get a corporate card with high limits, no personal guarantees in 3 business days or less, and pair that with software that allows your whole team to spend on behalf of the business and automates things like receipt collection and team request workflows and all that stuff in between.
So who's your target market for this product?
Today, our current market focus is really, I'd say, customers that have anywhere between 10 and 100 employees. So pretty wide cross section. I think that's really the vast majority of the Canadian economy.
So tell us a bit about this raise. How it came together and why you raised right now.
Yeah. So I mean, the context was we did our seed round. We raised our seed round in the spring. Most of that was done basically in May. I think we announced it sometime in mid-June. And we closed that round with the expectation that we wouldn't do our Series A for 12 to 24 months. We had a plan in terms of what we wanted to achieve and growth targets over that time frame. And fast forward to probably about 6 to 8 weeks ago, we had grown a heck of a lot more than we had expected. So we saw really big product pull into customers. We saw customers adopting Float throughout their entire organization, and organically we were growing way faster than we expected to grow. Especially with a really small team. We were, frankly, less than 10 people up until just recently. And so when a couple of funds, really strong funds, came along in late September and were interested in getting to know us, we shared some of our growth metrics, and the feedback we got in general was, you guys are doing exceptionally well for this category. We had talked to investors that had invested in these businesses or similar businesses around the world. And so we saw an opportunity to potentially accelerate our growth and product development by doing a round sooner, attracting a great partner in Tiger Global, and really just doubling down on our product development, our engineering team, and everything else that we're doing. So it was definitely not the plan. It was opportunistic, but we're excited about it.
So it sounds like it was opportunistic. I imagine growth brings some scaling problems, so it's probably good to have capital. What went through your head when you were considering if you should raise or not?
Yeah, I mean, we thought about what this would change. How would doing this deal change the future for us? And I think we felt, one way or another, whether we do the deal or not, whether we raise money or not, we have to execute. I'm huge on execution. I think execution is ultimately the number one thing. You need to focus with a great team for years to build a really great business. I thought that there was some capital risk associated with this industry, right? There are other players that are looking at the market. I don't think any of them, certainly in Canada, are as far along as Float is. And so we thought, if we do a deal now with a great partner that can invest more in us in the future, we can continue just investing really aggressively We don't have to be as tactical about what we do in the next 60 days, for example, and how we grow. We can actually go and build out, with confidence, the strongest product and engineering team, for example, in Canada. We can grow our sales and marketing team, and we can really go after this industry, with a ton of conviction. And I think we felt a lot more confident about doing that, just given the, frankly, the 8 or 9 months that I had in the business, seeing the pull that we were getting, having done, 100 sales calls myself, seeing the feedback from customers. It was very clear to me we were no longer searching for product market fit. It was very clear, we had a product in market that customers loved. We had a clear product roadmap we wanted to build, and so we really felt like we could allocate those incremental financial resources effectively.
So I love those answers. A couple, double clicks here. One is, you said you were around 10 employees, I guess, a couple months ago. How many employees are you going to get to? Like, how fast are you growing this team? What do you, if we're sitting down in 12 months, how big do you want the team to be?
Yeah, I hope that in 12 months we're about 50. Truthfully, we don't have extremely explicit headcount goals. I think they're kind of dumb, to be honest. I mean, you can have them, but at the end of the day, you have to hire really, really great people. We have roles that we weren't necessarily hiring for that we've closed because we found amazing people. And we've had roles open that we haven't hired for, even though we really need to, because we haven't found the people that we want to bring in. So I think ultimately, especially the first 25, 30, 50 people in a company is absolutely critical. But my expectation is that we'll likely reach 50 over the course of the next 12 months, maybe a little.
And then let's talk about the growth a bit, because it sounds like you had product market fit. And from what I read in some of the articles out there, you're growing at 100, 150% month over month. How much pressure is it to maintain that growth for the next 24 months? Because that's exponential growth.
Yeah. Yeah, I mean, it's been great to see. It doesn't change really any of what we're doing. I think that our insight so far in the business has been customers want this product, they need it, it creates tremendous amounts of value for them. And, we're in the first inning of the things that we want to build for all of our customers. So, we come to work thinking every day, not about, hey, how do we manufacture next month's growth, which obviously you need to do as a startup. But we don't really think about it that way. We just think about, if we keep building a product that our customer wants, we stay close to our customers, we keep improving our service, we keep building out our capabilities to better service them, those things are going to take care of themselves. So I try not to be too tactical and too focused on, hey, are we going to hit next month's growth targets? Obviously, we do look at those, but it all starts with, how can we better serve customers? How can we build the functionality they need? And if we do that, I think those things are going to take care of themselves. But obviously growing a sales and marketing team is going to be a big piece of the puzzle to continue ensuring that we grow the business in an effective way.
So I love, this is the second company I know that you've been associated with that's seeing product market fit and rapid growth. The other one being Uber. So for lots of founders listening here that hear about product market fit, you will realize it when you see it. Tell us what it feels like and what it looks like.
Yeah, I mean, I've been, I guess, lucky that, my two, I guess, startup experiences so far, I mean, it's very early days of Float, but, I think we've felt good product market pull. I think to me, what that looks like is, one, you have really high customer satisfaction levels. So, 90% or more of your customers say they love your product. You don't have to measure that in an extremely data-driven way. I mean, you can just use good judgment and your top 50 customers and say, what do you think about Float? On balance, even, in spite of whatever feedback you may pass along or things you want us to build, overall, how's your experience? Are you happy with it? I think the responses to that question could really give you a ton of clarity on whether you have a good product and whether there is fit. Certainly, you'll see it in the numbers. Our sales reps spend very little time acquiring customers. It takes, maybe 40 minutes, max 30 minutes for a sales rep on the Float team to talk to a customer, explain to them how the product works, and then kind of get them committed to joining the platform. And our close rate is very, very high. So I think that those are things that tell me we have product market fit. Certainly in the numbers, from an engagement perspective, we see not just new customers joining, but most importantly, every customer on the platform is using us more frequently each month. So I think those are the themes, or those are the signs that I would look for. And it's a privileged and lucky position to be in. I mean, it's really hard to find product market fit. I was very fortunate. I don't frankly deserve much of that credit. When I joined Float, my co-founders, Griffin and Ruslan, and the small team that was working with them had built this great product. that people wanted, but there was only a few people using it, and it was just early days in terms of the go-to-market. But they deserve all of the credit for building that product, and a product that clearly people really wanted.
I love that. I'm a bit conscious of your time because I know it's been a busy 4 or 5 months and a busy 24 hours in particular. So what is the biggest risk or potential hiccup you could see after raising such a round like this and having such fast growth?
I think thinking that we've achieved anything. I'm a pretty blunt person. I celebrate our round. I sent our team yesterday an email, recognizing that it was an important milestone for us and thanking everyone and saying, this is a great achievement, but we've achieved nothing yet. I think we come to work every day really hungry to build a great product, solve customers' challenges, and just give them great experiences. And I sort of represent our team that you need to do that for 5+ years to become a successful company, not 8 months, not 12 months, not 18 months. Fundraising is a helpful milestone. It obviously really helps from a resourcing perspective, but it actually, I think, says very little about whether or not in the long term Float has achieved anything. So I try to keep our team humble and modest and keep our eyes focused on the prize. And I think that's the biggest risk, that we do that we come to work every day with the same level of desperation and urgency to solve customer problems, grow the business, keep iterating on our product, and not take anything for granted, because just because we've done a Series A doesn't mean that anything has been predetermined in terms of our long-term success.
Cool. I love that. So sort of like Jeff Bezos' day one sort of mentality.
It's always day one.
Yeah. And last question for anyone that wants to find out about joining the team or being a customer, where should they go? And if they want to get in touch with you, how should they reach out to you?
Yeah, so floatcard.com, you'll find lots of information about our product. You can sign up there in minutes. It's very easy to get up and running if you're looking for corporate cards for your business, whether you're a small team, big team. We've got great solutions for you. It's free to use, and we offer 1% back on all spend, so that's an extra kicker. We are hiring across all roles: engineering, product, marketing, sales. We're actually looking for our first recruiter. We're looking for our first customer support manager. So reach out, apply online. We'd love to see you, and there's some really talented people joining the team right now.
Jason, coming up, do you have any last questions for Rob?
Nailed it, Rob. I love it. I just got one last question, which is, all this momentum, all this growth, was it ever a thought about not raising and building this company in a non-VC way?
It's a good question. I think we always had conviction we wanted to build a business really quickly because we saw this opportunity. We think other people see this opportunity. We think seeing opportunities or insights in a market is not hard. Actually executing it on it is the difficult part. And we thought that doing this round and going the VC route would allow us to attract the best people. And for me, business building is about building the best possible team. If you build a great team, you're probably going to create some of the right conditions to build a great business and a great product. So that's ultimately why we did it.
Love it, Rob. So go build that team. Thanks for sharing your time with us today.
Thanks, Rob.
All right. I got to ask you this question, Alex. This is exciting. You've gone deep with Rob. What can founders in the TechTO community learn from this journey so far?
Well, first of all, I think we've said this a few times over the last 36 weeks or 40 weeks. Canada only place where fintech do work. So that old trope, which we've now probably beaten to death, if you are a Canada only play, maybe it doesn't work, but for fintech, there's definitely demand, especially in SMB banking, where the feeling generally out there is the incumbents have ignored this whole sector. So Float is focused on Canada, focused on SMB banking, huge demand. Second, momentum with a proven playbook in the US. So you got in the US, you got Ramp, you got Brex, gives funds like Tiger the confidence to provide eye-watering sums of money and valuations early on. So they see the momentum here. They see what Ramp and Brex looks like. They have comparisons. They feel like they can pay for almost like the next round up front. The flip side is this is going to be a crowded market. Like, I think I've had 7 pitches in SMB financial services over the last 2 weeks. They all seem to be getting a bit of money. And this investment implies it's a winner-take-most market. So I think the capital gives the company the ability to spend aggressively and to build a brand, sort of like what Wealthsimple did. Wealthsimple started out, there was 7 or 8 competitors, and more importantly, hire the talent to basically outcompete the competitors, which I think is essential. the one flip side is if the competition ends up being fierce and reduces margin or fragments the market, it can create significant headwinds for the company and for the valuations. So I think if you choose to play momentum race, have the metrics, know how you'll spend the capital, and realize it is a go big or go home strategy. So I want to see more founders in Canada swinging for the fences. I want to see them raising big money, trying to build massive businesses quickly. But there is it's a much more binary outcome than being a conservative Canadian that historically has happened.
Got it. We're going to talk about what happens if you don't have momentum coming up next. But first, if you love keeping up to date on how companies like Float and leaders like Rob are shaping the Canadian tech scene, you've got to subscribe to the TechTO newsletter. Alex, what can subscribers expect in tomorrow's newsletter?
Tomorrow's newsletter will have a bit deeper breakdown of one of these quick takes. We'll have some must reads and some of the highlights of articles of news across the Canadian ecosystem from the past week.
Love it. So you got to subscribe to our newsletter at techto.org to stay on top of the latest trends, stories, resources, and events. Next up, don't have momentum yet? Well, it pays to be a repeat founder. Practice raises $10 million US. Alex, who did Practice raise from?
Practice raised from a company fund called A16Z. You may have heard of them. Actually, Andrew Chen was the person that led it. Andrew Chen actually has an Uber connection as well, was head of growth there for a while, so he knows about growth. And he had participation from Andrew Wilkinson of Tiny and Tony Robbins and 40 other investors. So they kept it around kind of exclusive.
Yeah, right. And who is Practice?
Practice is building a coaching business software that enables coaches to run their entire business on this one platform. Anything from scheduling to billing to anything you can need as a coach. And Practice claims that it's building a platform for coaches of all types, from executives to spiritual development and everything in between. And then once they conquer that vertical, all those sub verticals, they'll be able to use it to other white collar type of professionals.
And is this also 150% growth month over month business?
Not yet, or not that I know of. I think there's a closed alpha out there where Julian, the founder, is being very careful to make sure that the product has stickiness. He gets feedback before he goes and markets it heavily.
So how does Julian make a $10 million raise before they've got the real eye-watering numbers like Float does?
So Julian is a serial founder or second-time founder in this case, and VCs love him.
Tell me about the first one, though.
So this first one was a company out of Montreal called Breather. Do you remember Breather?
I remember Breather very well.
I think me and you've used Breathers for meetings in the past. So Breather was like a WeWork, but it was office in someone else's tower that you could rent out by the hour. So mainly meeting rooms. They were a bit of a darling. They raised 150 million USD. But
what had happened to it?
They sold for 3 million.
So that's a pretty major implosion. So how did Julian raise again?
Well, like I said, VCs like backing serial founders, and there's several reasons for this. First of all, if you try to build one company before, to go start another one, you have to have a higher level of commitment and a bit more eyes wide open, because you know how many times you're going to hit in the face. So the first thought is, hey, if someone's tried to build a company before, raised a lot of money, it didn't work out, and they're going to do a second one, they're probably more committed. They know what they're getting into. So this is a very strong commitment. Second, Julian raised before. He raised 150 million. This tells the VCs he's proven he can pitch, he's proven he can recruit employees, and he's proven he can sell to customers. So one important skill set's taken care of. If he's got an education at someone else's expense, so he should be smarter. He knows he has probably team members he can pull on and VCs that he's worked with that like him. So he has relationships, and he'll move faster. He knows how important it is to move and show momentum.
I love it. So lots of deals out there. What else is really notable about this one?
So I'll compare it to Breather. So Julian, Practice is so let's start with Breather. Breather was a tech-enabled job, basically opportunity. It was taking, technology to book rooms.
Mm-hmm.
Practice is software first. So what's the implication there? It's gone from low margin business to high margin business. He's now building a closed beta. I don't think he could really do that with Breather. So he's making sure the product works before and scales up. His initial vision and pitch about market size shows how the product can expand, but where he's focusing an initial wedge. And this is actually something very hard to do, because every VC says they want to see a huge market, but they also want to see you dominate. So if you go and say, hey, I'm selling to all public schools in North America, like, you got no traction. You got 2 schools, but now he's like, hey, I'm going to focus on these type of coaches. They love it. There's a good, word of mouth, and there's good traction, but this is going to apply to like 15 verticals.
Mm-hmm.
And then all these lessons may be lessons he learned from stuff not to do while building breathers. So it's, I find that very notable about what he's building right now.
And if you're thinking about starting a new business, what do you learn from this raise?
Well, if you haven't started a company before, you should start one just to close up shop and raise for a new idea. That won't work. What you may want to do is, if you don't have a great idea right now, join a rocket ship as an early employee, or rocket ship. People that have been at rocket ships get the same benefits of fun when it comes to fundraising. One of the reasons that Float's succeeding, even though he's modest and Float got so much interest, is Rob was part of Uber and a big part of Uber's growth story. So people got super excited when he joined Float as a co-founder and CEO. So if you don't, again, don't start one to just quit. But if you don't have an idea you want to pursue right now, go find a rocket ship and join it.
I love it. And if you want to keep learning and growing and finding those rocket ships, you got to join us next Friday when we'll be talking with Alex Baker from Relay Ventures about the founder VC relationship, what he looks for in a pitch, and the tips that he wishes founders knew before pitching. Alex, what are you looking forward to chatting with Alex most about?
Well, other than getting confused with the names, I look forward to hearing Relay's perspective. Relay is one of the older venture funds in the Toronto area. They've seen the growth of the ecosystem. They've always been an active investor outside of Canada. So I'd like to see how they compare deals here, how they compare this ecosystem to US opportunities, and what makes them invest.
Love it. Next up, scaling hardware is hard. Ecobee sells to Generac for $770 million. What other details do we have on this deal, Alex?
This deal, $770 million, is a headline, but it includes $200 million cash and $450 million in common stock up front. So there's a bit of a difference there between that and 770. The other $120 million is common stock based on Ecobee hitting performance targets between now and June 30th, 2023.
Got it. So there's some performance
incentives,
compensation in there. Let's talk about the basics. Who is Ecobee?
Well, I actually have an Ecobee in my house. They're known for their smart thermostat, but they're a smart home company. That means, the devices are smarter than the traditional ones. So they were founded in 2007 in Toronto. They've raised $200 million previous to this acquisition. And what was interesting, products are built to be platform agnostic, and they were built using Alexa so they could have a voice interface. They had many different products. They had most recently launched a voice-controlled home security system.
And now investors in Ecobee own a bunch of stock in Generac. So who is Generac?
Generac is a bit older. They were formed in 1959. They're based in Wisconsin, and they make backup residential and commercial power generators. Not something I usually think with smart devices or smart homes. What's interesting, they had recently started acquiring several smaller companies over the past 18 months, including a company called Pika Energy, Enable Power Technologies, and Neuro Technologies. And they're combining them into an energy storage division, something that's a bit more green, something that's a bit more, I guess, forward-looking.
So why does Ecobee sell this business?
Look, I'm not part of the Ecobee team. I'm not an investor, so I have no direct insights. But from what I could gather, it's a combination of fierce competition and failed product execution. So,
do you want to expand on that?
Okay, yeah, sure. Let's start with the product execution. Look, if you look at their core products, their thermostat, they have not shipped a new one since 2019. And several years ago, they announced a large product line that never came to market, or what did come to market flopped. So one big bit was smart switches. So you'd have switches along your house that you could talk to. They could play music. You could tell them to turn off and on. That came. I think it's gone. So lack of product innovation. It's hard to do hardware, right? So I think they tried to do too many products, and it just didn't execute well on getting new products to market or getting distribution. Then let's talk about the competition here. Competition includes Google and Honeywell, and recently Amazon entered the fray. Amazon just announced a smart thermostat themselves. What do all these competitors have, including Honeywell? They have more human and monetary resources, better distribution. So like Google and Amazon can plug into their digital distribution. Honeywell has a bunch of retailers and HVAC people they'll sell their products, and the ability to ship products fast. So when you look at where you are, it appears that Ecobee needed deeper pockets to better compete, and they were looking at a SPAC, they were looking at raising more money, but they took the acquisition offer.
And so they took this offer at 770 to Generac. Is this a win for Ecobee and for Stewart and investors?
Well, I think for Stewart it is. I think let's look at I always like looking through the lens of the last investor. So if you look at it, it looks like it's an okay outcome, not a venture scale outcome. The last round, from what I read, was 36 million USD. So let's put 180 million roughly USD, maybe 200 million valuation there. So the cash up front basically gets the investors break even on sort of what the valuation was.
Sure. And the early investors, of course, make a
yeah.
lot more money than those people came in at that exact valuation, right?
And then you get 2.5 times when you include basically the common stock.
Mm-hmm.
So the total outcome, if they hit their numbers, could be around 5x for late stage investors, and early investors will get a bit more, a good return, but not a great one. So it's definitely not a loss, but it's not like it's not one of the ones where you get these like hey, we made 1,000 extra money. So I think if I'm from a venture capitalist perspective, this is one that helps build your portfolio but doesn't make it. And for the employees, I'm hoping that there's quite a few employees that did well in this.
I hope so too. And if you're an early stage entrepreneur in Canada, what do you learn from this exit?
There's a lot of talk about launching hardware companies being hard. I actually think it's a lot easier to launch a hardware company than ever has, but scaling them and creating value is extremely difficult. To build a successful hardware company, you need to build products, you need to build demand and awareness and distribution while competing with large, well-financed companies. Furthermore, I think which people don't realize is hardware companies don't get the same valuation someone like Float will get, right? They get relatively low valuations. And that's because you don't have the repeating revenue. So if you look at the examples in the headline, in the headlines or the headwinds this causes, you can look at in just Toronto Waterloo area, you had North, Muse, ClearPath Robotics, NIMI, Pump Strength, and Ecobee all had significant early traction, but I'd argue none has built a breakthrough company that, some look like they were on the way, but they all stalled out to some extent. Maybe ClearPath Robotics will still get there, but the rest of them, basically all sold, or I guess Muse is still alive, but like they're not the rocket ships. What's interesting, there's a new model emerging for hardware companies. They're looking at SaaS plays. They're building a subscription business, and they're getting valued like a SaaS company, which allows them to raise the capital they need to build a product. So, and they try to build it in relatively green spaces, not trying to compete in known commodity places. So, perfect example of this is a company called Whoop. I don't know, are you familiar with the Whoop band?
I've heard of it. It's the sleep and activity tracker band.
It's more like, it tells you how much you should exerting yourself sleep. It's a band you put in your hand, and instead of charging you for the Whoop band, they charge you subscription, and they give you a bunch of analytics and stuff like that. And they just valued, I think, at $3.6 billion. Like, it's a SaaS valuation. I think the Oura Ring is another example. They came out with the Ring, but they've just added a subscription service. So you see this whole new stage of exciting hardware companies trying to tackle stuff like, the enhanced self, or the statistical driven health,
quantified self.
Thank you, quantified self, that are selling subscriptions, and so it's a different basically way to approach the market. The only question I have about that approach is, how many subscriptions do consumers want to pay for?
I think a lot is the answer. I think a lot of spend is moving towards it, and there's been plenty of applications that have helped you manage them. But if you look at the unbundling of cable, people are now paying more than they did in the bundle, probably for less, but more of what they wanted. I know I do in my household.
Do you have any of the quantified self hardware stuff?
No. And I would be a good target for it too. So still a big market for them to tap into.
Well, I feel like even that's not easy. I ordered a Whoop on September 1st, and it keeps getting delayed in shipping.
Oh, there's another thing. Software doesn't have supply chain issues, does it?
Yeah. No, not that I know of. Maybe, maybe you can't get developers these days, apparently.
That's a different part of the supply chain. You're right. They're not stuck in a container at the port. And if you want to join a community of Canadian tech founders, entrepreneurs, and investors struggling with hardware and software, you got to check out the TechTO.org Insider Membership Program. Alex and I are there every single day answering questions, making connections, and just helping you be part of the community. Alex, who have you met recently in the Insider program?
Sandeep Todi.
Tell me about Sandeep.
He's a co-founder of a company that used to be called Remitter. It's now called Truly Financial. And it's another company targeting SMB finance. Just different angle, different problem they're trying to solve than Float.
Amazing. And did you learn something from Sandeep or share something that could help him?
Well, we were talking about fundraising and who and how to go to market.
Awesome. Very cool. A lot of fundraising talk happening in the TechTO Insider Slacks these days. And now our lightning round. First up, Uvaro raises $12 million US. Who participated in this round, Alex?
So first of all, the company's name is Uvaro Tech Sales Training School. So not an easy one to remember. They got from White Star Global, Amplify, BDC Capital, Real Ventures, which is notable because that must be follow-on, X Fund, and Garage Capital.
Now you see hundreds of fundraisers, Alex. Why are you particularly interested in highlighting this one? It can't just be the long name.
Well, the long name did attract me, but I think there's two reasons in particular. One is this is it's basically seems like to be the next version of General Assembly, and the 2000 early 2000s you had a bunch of coding schools. Mm-hmm. Now you're seeing a bunch of training schools that use technology and have a career accelerator for tech sales in this case. So that's interesting because it seems to be these companies sort of get exciting, get funding, and then they never seem to blow up. But now I'm seeing a whole bunch of these companies get funded right now again. Second of all, this is a spin out of Kite, which is interesting. I always like to see spin outs of other companies. And third is they have a mission to basically train more women of color and help them transition the career in tech sector. So a few things I love. I'm always fascinated by this trend to help people get educated via tech. I love that they spun out, but more importantly, I love that they're helping address the second week in a row. We have someone that's trying to address the so-called pipeline problem to make our ecosystem more diverse.
I love it. And are ISAs still hot? Are they doing the ISA thing?
Did not read anything about ISA, but there is a bunch of them doing it. A bunch of companies still doing it. The other thing we should note, if why do I care about this? Joseph Fung is a serial founder. So again, goes back to helps raise money when you're a serial founder.
If you don't have momentum, be a repeat founder. And next up in our lightning round, AlayaCare goes shopping. What did AlayaCare buy on this spree?
AlayaCare purchased Pennsylvania-based Delta Housing Technologies. It's their 5th acquisition.
Oof. And why are you watching this deal?
Well, simple reason. AlayaCare raised money for acquisitions to grow in the United States, and that's what they're doing. Love it when people keep the narrative simple and then execute against it. And I also love there's a trend we're seeing. Canadian companies are now being aggressive acquirers. We're no longer being acquired. And I think the big narrative when I go talk to people in the States is they still think Canadian companies grow to 20, 30, 50 million revenue, valuation, and they get acquired. But what I've seen now is less Canadian companies get acquired and more companies acquiring Americans. Let's be there. Let's build this ecosystem. Let's be the aggressive companies.
I love that. What a week in Canadian tech. If you haven't already, you got to like and subscribe to TechTO wherever you're watching or listening. We'll see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.